Hey, Jason Rogers here. And in this video, I wanted to talk to you about debt versus equity. I've been getting this question. I want to go more into equity because in a prior video, I talked about key financial terms you should know. That video really lays out some of the basics about debt, but this one, I want to talk to you about debt versus equity and how to really fundraise deals. Not that I'm a I don't have 20 years at Goldman Sachs. Hell, I haven't been an adult for 20 years. You can probably look at my face and realize that. But I've done a 7-figure deal now. I have experience in the trenches, and I have some real powerful mentors and board members behind me that are really guiding me, giving me exceptional advice. I've taken advice at this point from people at the top of their games in legal and accounting and finance, in real estate, and in M&A. So I know I can really help you some in this video. First of all, debt versus equity, what are the differences? Debt, I always use this metaphor. It's not even a metaphor, it's just a little catchphrase. Debt is about minimizing downside. Equity is about optimizing upside. AKA equity investors, think a private investor, think a private equity fund if you want to go down that route. They're looking for upside. They want to get a preferred rate of return. They want to really see a considerable gain on their capital invested. On the other hand, when you procure debt, the banker's looking to minimize downside. Because irrespective of how successful your project is, the banker is going to get the principal plus the agreed upon interest that you loaned. It's really that simple. Now, I'm going to go into some of the nuances of debt versus equity. But first, I just want to give you guys a behind the scenes look into my life right now and be really candid with you. We just closed our deal 2 weeks ago as of today. And I'll show you around my place right now. Like, first of all, this is where I sleep, just a futon. That's my desk. I still haven't set it up. It's been 2 weeks, still not set up. Why? Because I've been working nonstop. Here's my bedroom. Let me show you. This is my bedroom. Okay. There's a mattress and the frame and all of that jazz. Now, why haven't I set all that stuff up? Again, because I've been working nonstop, right? If I pulled out my wallet, which here it is, you see there's some serious amounts of cash in there, right? So it's one of those where life's not about balance. I don't believe in that. Sometimes I hear these people saying about how you can have it all the health, all the wealth, all the everything. And while I believe in the long term, you can probably achieve most, if not all, of your goals. When you're scaling a business, it's really tough to have it all. That's why, for now, I just sleep there. Because why? It's fast. This apartment that I'm in right now, I may not be living here in a month or two. Why? Because it's not quite ideal for the location I need to be in for me to scale my business. Right? So you make these decisions on the fly quickly, and you don't always get them perfect. You aren't always able to get your desk scheduled, right? I'd rather be shooting these videos with perfect lighting and a perfect video, my perfect desk that's gonna sit in that corner, an L-frame desk. But you know what? Haven't gotten to it yet. Why? Again, busy, growing a business from scratch, making it happen in the trenches, working 14, 15, 16 hours a day, almost every day of the week. I work 9 hours a day in the business, then I work another 5 or 6 hours a day on the business. And this is including working on the business, right? Because providing value to you provides value for me. And along those lines, let's talk now about debt and equity. So I'm more sophisticated in real estate than traditional M&A, but there's a lot of overlap because equity investors are looking for upside irrespective. Now we're going to start with equity. So if you're in the real estate game and even in M&A, I would imagine as well in M&A, there's things called waterfalls and clawback clauses. And those are some sophisticated terms you can Google, but essentially it's about after you give your investor or investors, plural, their preferred rate of return. In real estate, a pretty standard preferred rate of return is 8%. So what that means is, hey, you give me $100,000, I'm gonna pay you $8,000 every single year, right? That's 8%. That's a traditional preferred rate of return that you can go into the open market and generally procure if your deal makes sense. Now, if your deal doesn't make sense, nobody's going to want to invest in your deal. But if you're able to sell your deal, then you're going to be able to most likely get that preferred rate of return. But what happens if your deal makes 25% return on investment and the investor was promised 8%? Well, depending on how you structured the waterfall or the clawbacks and all these legal terms you can talk to your lawyers about once you procure your world-class team, which I talked about here on YouTube many times, how much of that extra profit goes into your pocket as the general partner versus the investor's pockets as the limited partners, aka the passive investors? And that's really how, that really comes down to how you structured your fund, right? And how much equity you gave away ahead of time. Something you can do is say you buy a $10 million asset and you're going to use 7 million in debt, aka leverage, and you're going to raise 3 million, right? What you can do is not only give the 3 million, and say you could raise that 3 million from 10 different people. 10 people put 300 grand in each, right? And so then what happens? Well, you could say to each of those investors, okay, I'm going to give you an 8% preferred rate of return on your 300K that you invested per year. A preferred rate of return doesn't mean it's a guarantee, but it means if there's cash flow after the debt service and the business's expenses or the real estate's expenses, that the first person to get that return is going to be the investor. Now, after once you give them an 8% return though, if there's even more upside, do they get to capitalize on even more of that upside? Well, again, that's really what you negotiate with your investors. And I would say to you though, that's enough for you to start. The idea that you can give a preferred rate of return and you can give equity in your deal. So another one, right? If to use the same example, $10 million deal, 10 investors put 300K in each. Let's just say 3 million, right? For that 3 million in capital, what percent of the deal does that total pot of 3 million own in the deal, right? So a 1-to-1 arbitrage is saying, okay, you put in 30% of the capital, you own 30% of the deal. You put in 10% of the capital, you own 10% of the deal. What you can also do is say, okay, you put in 10% of the deal, I'm gonna give you 15% of the deal. So that's a 1.5 to 1 arbitrage. It's basically a buy one, get 50% extra. Or here's one, a buy one, get one free equivalent, right? You've heard of a BOGO, buy one, get one free. Well, what about, okay, you put 20% of the capital into the deal, I'm gonna give you 40% of the deal. That's putting $1 in and getting $2 worth of equity out. Now, it better be a great deal where you can easily pay out that investor and make it all work with the debt service payments and your business expenses or your real estate expenses, etc. I'm not gonna go into all of that right now, but these are some general ways of you to think about deploying equity. Now, why would you want to procure equity? Before we talk about how to get equity, why would you want to procure equity? And the real simple answer is because some banks they'll refuse to work with you if you don't put in equity. If you don't have a down payment, they're going to refuse to work with you. Now, you can get around that sometimes by having the free cash flow covering debt service by an absurd amount, basically by negotiating a great deal, getting a deal at a steal. You can get around that perhaps by being a great operator. Banks will be a lot more lenient with you if you're a great operator and they know that you have that Midas touch. Whatever you touch turns to gold. If you have a proven operations team, they may say, you know what? We will require less, if not maybe any equity from you because we know when you operate this thing, you're going to make it great, right? So that's something you can do. Also, if you're able to get somebody to guarantee the loan or if you guarantee the loan with a super high net worth, that can be a way to get around equity. But if you don't have some of those lob tosses at the net for bankers to say, slam dunk, we'll give you the money without any equity, then that's how you're going to probably want to structure the equity. But now the question becomes, where? Where are you going to find investors? Well, there's a lot of places you can find investors. One is LinkedIn. I've talked about LinkedIn before. I'm pretty active on LinkedIn. You can follow me or connect with me at Jason Paul Rogers. It's linkedin.com/in/Jason Paul Rogers. Find me there. And you'll see I quite regularly post content on LinkedIn, and I get thousands of people viewing every single post now that I put out. In most cases, I get 2 to 3 to 4. Even my more recent post got over 5,000 people who viewed it within the first 2 weeks of me posting it. Many of the people viewing that post or those posts that I put out are lawyers or accountants or doctors or other investors, etc. So you can imagine how that's going to be favorable for me if and when I want to fundraise subsequent deals, right? Because I'm already on their radar. So that's one way you can use LinkedIn. Of course, you can just spend time in places where high net worth individuals are going to be. Think high-end restaurants. Think 4- and 5-star hotel bars or the lounge there. Think golf courses or country clubs. Right? Think first class on the airplane. It's pretty unlikely you're going to find a future investor in, seat D in row 34. But if you're in seat B in row 2, aka you're in first class, your odds of meeting a high net worth individual just went up. Right? Of course, you could also think of any high net worth individual in your network. That's a great place to start. Obviously, that's what the insurance companies teach you. If you ever worked a day in an insurance company, the first thing they do when they try to get a new person in the company to sell insurance policies is they try to get you to sell insurance to all your friends and family. It just so happens that that's a way where you can fundraise capital for your deals as well. Other things you can do, though, you can use some of the GoFundMe platforms or the equivalent, right? You can post your deal online and go about it that way. Those would be some simple ways. Other ways, you can use accounting and law firms, or you can even cold call top accounting and law firms near the acquisition target itself and say, hey there, do you have any high net worth individuals that would be looking for an X% return combined with Y% in equity in X or in Z type of a deal? That can work, right? So you can call professional firms and pitch the firms to basically then pitch their clients. So there's a lot of ways you can go about finding opportunities to basically find equity for your deals. But then, of course, it's all going to come down to execution. How persuasive are you in selling your deal, your vision, your company, your operations team? You know, how certain of a deal is that you're offering? The more certain you can be about your deal, the obviously more successful you're going to be in procuring the fundraising that you're looking for. Another thing to be aware of is making sure you don't violate securities law when you fundraise equity. You're going to want to really make sure that you are either targeting accredited investors and you create a proper fund, or you create the proper, I believe it's called, I'm blanking on the word. It's super late right now. I think it's midnight at the time I'm recording this, but it's your offering, right? You should be very clear in what your offering is, the return the investor is going to get, and you're going to want to consult with legal professionals. And if you've built your team like I've outlined here, you will have those legal professionals that can help you build a fund or basically create the proper documentation to receive money in a legal way. You can also go after non-accredited investment, but be very careful with that. A non-accredited investor, as a side note, I believe, is somebody with a net worth of less than $1 million. It depends too if you have a spouse that's making money and you're making money. This is all for the United States, by the way. If you're in Siberia, I don't really know what to tell you as far as securities law there. But in the United States, if somebody's worth over $1 million, their assets minus their liabilities, then generally speaking, that's an accredited investor. And it's a bit easier to get capital from accredited investors. There's less hoops to jump through than a non-accredited investor who's going to have a net worth that's less than, I believe, about $1 million. So those are all considerations there. But now, why would you fundraise equity? Again, so that you can procure the debt necessary, or so that you can maybe use all equity and then just buy a property or a business outright. But traditionally, banks are going to want, at least in the commercial real estate space, about 20 to 30% down, and then they'll leverage 65 to 80% is pretty standard. We were able to procure 88% leverage with our first deal, and that took a lot of work, right? It would have been easier if we put more of a down payment, right? If we put 25% down, it would have been a lot easier to procure the remaining debt than what we did at about 11.7% down. But some of the big variables are going to be the free cash flow after debt service. How much free cash flow as a percentage is left over after debt service? So for example, say your business does $1 million a year in revenue. Say your traditional business expenses are $500,000, and then say you have no debt payment. Well, that means in that example, you have a 50% gross margin, right? You make $1, but you have 50% in expenses, you keep 50 cents. Or you make $1 million, you have $500,000 in expenses, you keep $500,000 in your back pocket, or to distribute to your team, partners, not employees, but more your partners, right? Because employees would be part of that expense in the $500,000 expense category. But now let's throw debt onto it. Say you also have a $300,000 debt payment. Okay, so your debt coverage ratio is your net operating income, aka your EBITDA, depending on if you're in real estate or in traditional business, divided by your debt service payment per year. So in the example we were using before, your net operating income there was $500,000, right? But your debt payment is $300,000. So the free cash flow after debt service is the $500,000 divided by $300,000, and that equals 1.66666666, aka you have 167% free cash flow after debt service, aka you have 67% margin after you pay your debt. That's pretty good. Anything over 150% is interesting to banks. Over 200% is really interesting to banks, and if you can get over 250%, now you've got a steal of a deal. But that's going to be what the bank's trying to understand, is how much free cash flow is going to happen and be available on average per month and really per year after this guy pays off all his expenses, right? After all the income divided by the debt payment. And that's really what you want to think about when structuring deals, because obviously if you can't make your debt payments, you're going to lose the property or you're going to lose the business. And that's a failure, that's a catastrophe. Now, levers you can use to influence your debt payment per month: amortization schedule, interest rate. Those are really the 1-2 that you're really going to be able to use to leverage or really to alter your debt payment per month. Now, of course, you're going to have to get the bank to go for it. So if the bank wants to do a 20-year amortization schedule, which I won't define amortization schedule here. I believe I talked about that on a prior video. In fact, I did. It's about, financing terms. You can look that up on YouTube, but you can morph your amortization schedule, 20-year to 30-year. If you go to 30-year, that's going to mean you're paying less in debt payments per month. A 10-year AM is going to mean you're paying more aggressively. It also means you're building more equity into the project more rapidly. So there's pros and cons to amortization, but based on that amortization schedule and the interest rate is going to really determine, and of course the loan amount that you procure, that's going to determine your debt payment per month. And obviously you want to make sure that you can make that payment every month. Otherwise you're going to lose the property or you're going to lose the business. But at the end of the day, bankers and investors alike are looking to know that the deal is solid and that the operators are solid. Ideally as well, if you have a high net worth or if you put equity into the deal, something that gives them extra confidence, right? Or if you are willing to put your home on the line, something, like banks especially really want to be certain that no matter what happens, they're going to recoup all of their principal back, either because the business is easy to liquidate and they can get the money back that way, or because they're going to take the business and liquidate that and liquidate your home. And when they liquidate both, that's going to equal the principal plus hopefully the interest for them. Banks, again, are trying to mitigate downside. Investors are looking for upside. So, if you want to keep 100% of the deal, you use 100% commercial debt and maybe your own money. If you're open to the premise of giving away some equity, then it's definitely easier if and when you put that capital into the deal. But those are some ideas about debt and equity. Hopefully that makes a lot of sense to you. If you have questions, drop them below. Again, I am always here to try to help you be successful. And with that, I'll talk to you in the next video.